If you are a passive investor, it's a great time to partner with an operator that has experience, that has knowledge, that's been doing this. And there's a number of us out there that are like that. A lot of inexperienced people in the space today trying to grow fast. I talked to somebody a month or so ago, and he said, yeah, we did 8 deals last year, and it was like 1,200 units. And I thought to myself, why would you do that? It just, the instability in that type of growth doesn't help anybody.
Hello, everyone, and welcome to the Journey to Multifamily Millions. I'm your host, founder, and CEO of Zana Investments, Tim Little. And on today's show, we have with us Mike Morawski. Mike is a 30-year real estate investment veteran. He has controlled over 285 million in real estate transactions. He is also an entrepreneur, author, real estate trainer, public speaker, personal coach, and chief investment officer of 2 multifamily hedge funds. Mike, welcome to the show.
Hey, Tim, thanks for having me. I appreciate it. Glad to be here today.
Yeah, and it is great to have you. So I gave everyone a very high-level overview of your rather extensive background. But on this show, we really like to get into the details of how you got started on your journey. So please take us back to the beginning and tell us how you got to where you are today.
Yeah, great question. And I always say that the journey is really where it all happens, because none of us get to where we are today by just waking up one morning and being there. Like you said, I've been in real estate 30 years, but I started out in the construction business. I had a general contracting business that I built up. And like any entrepreneur, I got to a point where I was just burnt out on what I was doing. I was doing all the ordering, the marketing, the sales, the contract writing, the hiring, the firing, and still in the field banging nails. And I woke up one morning, I remember sitting up in bed vividly and looking at my wife and saying, I'm done. I can't do this anymore. And decided to sell the company. And I was fortunate because I had somebody banging on the door wanting to buy the company. And I sold the company, and like any good entrepreneur, I was going to take a year off. We all never can take a year off or take time off as an entrepreneur. It's just baked in our DNA that we keep working. So I went out and I house hacked a couple of 2 flats. And Tim, this was long before house hacking was sexy. Everybody does it today. They live in a place, they fix it up, they sell it. And I did that a couple times, and everybody thought I was crazy because nobody did it at that time. But what I did was I met a real estate agent along the way. And I had heard Jim Rohn say years ago that success leaves clues. And I met this real estate agent that was really successful. And I went to him and I said, hey, I think I'd like to go in the real estate business. And he said, I think you'd be great at it. So he encouraged me to go in the business. I asked him then if I could come back and shadow his team. He said, no, I'll do one better for you. And he made me a cassette tape. Now I'm dating myself because I don't think we could find anything to make a cassette tape on. But I equate it to the podcast of today. It's that recording we can go back and listen to over and over again, which I did. And I got those messages, those fundamentals ingrained in my DNA and became part of me. And I went in the real estate business. My first 9 months in the business, I sold 78 houses. I went on to be RE/MAX Rookie of the Year that year. I built a team selling over 125 listings a year and did that for about 12 years consecutively. 2005 rolled around and I saw the market starting to shift. Wasn't exactly sure what was happening in the market, but I knew something was going to change. And I'd always wanted to be in the apartment business. I had watched a couple of large apartment syndicators in the Chicago market grow and do really well. This is what I knew about the syndication business. You raise private equity from individuals, you marry it with a great real estate deal, you stay in the middle, and as long as everything goes well, everybody profits from it. 2005, I syndicated my first apartment deal. And over the next 30 months, I raised $18 million. I bought 4,000 apartments in 5 markets and went on to build a property management company managing 7,500 doors. So I grew a company in 30 months to $100 million in value.
Wow. Okay. I do have some questions. Obviously, you were super successful, like straight off the bat. And it's interesting to me because I always thought within real estate in general that I would hear more stories about real estate agents becoming real estate investors and becoming very successful at it. But it's not a story I hear as often as I would expect to. Why is that?
That's interesting. So when I first got into real estate, it's interesting you bring this up. When I first got into real estate, I used to follow a national trainer by the name of Mike Ferry. He's a real estate sales trainer. And he used to say, buy your best listing once a quarter. And I don't think I ever bought my best listing once a quarter, but I certainly bought a couple of properties a year for a number of years. And I built a great portfolio as a result of that. But here's the statistic, Tim. 92% of real estate professionals, whether they're an agent, a lender, in insurance, whatever they're, real estate professionals do not invest in their own product. And I find that more so on the commercial side, doing large apartment complexes or commercial properties, that those agents do not invest in their own product. I find it amazing. I don't know why, but I think that there's a great opportunity for a capital raiser there to go and prospect, right?
Yeah, absolutely. And speaking of capital raising, you talked about that first syndication that you did in 2005. You raised $18 million. Please talk to me about that because I am having trouble wrapping my head around those numbers, especially back then, and for someone who's doing it for the first time.
Yeah, let me quantify that. So I did my first syndication in 2005. It went well, but from there, over the next 30 months, I raised $18 million. So that was over a 30-month span, which back then was a lot of money. But that first deal and that first syndication I did in 2005, Tim, it was crazy. I put a classified ad in the newspaper. And again, I'm dating myself because I don't think you could do this today. But I put a little classified ad in the newspaper that said, real estate investors wanted. Nothing about investing in a deal or raising capital or anything like that. My phone rang off the hook and I talked to people about partnering with them. And over 9 months, I raised $700,000 from that $45 ad.
Oh, wow. That is amazing. Yeah. I wish we could get that kind of response on Facebook ads or LinkedIn ads nowadays, but I don't feel like that's the case. So this wasn't a matter of family and friends, you calling up. It wasn't necessarily the organic network that you had already built up, or was that also part of it over time?
Yeah, in that $18 million, Tim, no family and friends ever invested with me.
Wow.
Yeah.
Yeah, that's really interesting. All right. And so when you had your construction business, and that seemed pretty entrepreneurial in nature, just based on how you grew it, but it sounded like you were working more in your business than on your business. And that's really what burned you out. What lessons do you think that you learned from an entrepreneurial perspective based on that experience?
So you must have read the E-Myth or the E-Myth Revisited to have that comment, because I did. I really worked in my business, not on my business. As much as I tried, because I'd read Gerber's book way back then about how you should not invest, not open a business that you know how to do. Go open a business that you don't know how to do, and you're going to be more successful. But the lessons I think I learned were, first of all, hard work, grit. The buzzword today is grit, right? I learned how to stay committed. I had a passion and a burning desire to succeed in business. And those lessons, I think you learn along the way. One of the most valuable lessons I ever learned was I went to a Robert Allen real estate seminar. And I don't know if anybody remembers Robert Allen, but he was always touted as the real estate investor that said, put me in any city in the country, take my wallet, and by the end of the 3 days, I'll own real estate and have money in my wallet. And so the St. Louis Times took him up on that, dropped him in the middle of St. Louis, took his wallet, left him $20. And by the end of the weekend, he owned 3 pieces of real estate and had a couple $1,000s in his pocket. I was hooked after listening to that story, going to his seminar, but I learned creative financing, no money down, other people's money, right? And from there, I think I just got the fever for real estate investing.
Yeah, and from 2005, it sounds like you're riding pretty high there and things were
Yeah.
going really well. We know there was some turbulent times ahead. Why don't you talk to us about what happened post 2005?
Yeah. So 2005, I saw the market starting to shift, went in the syndication business over the next 30 months, built this great successful company, right? By monetary terms, by the worldly standards, it was a successful company. But there were a couple mistakes I made along the way. One was I grew way too fast. I was very unstable as a company. I had 38 different companies, 100 employees, and I didn't, so I was very unstable in my growth. I owned $60 million worth of real estate, over leveraged at 85% loan to value. And I tell people, and I always say, I don't know who was worse, me for taking the money or the banks for giving it to me. And I tell people today, do not be more than 65 or 70% LTV in your real estate transactions today. And then the third thing, I was undercapitalized as a company. I just didn't have the money to grow like I was growing. 2010 rolled around. 2008 was like hitting a brick wall in a freight train at 200 miles an hour. The whole world imploded. The stock market came off the rails. Everybody started to unravel, and there were issues in the markets, in the financial markets. By 2010, it had caught up with the commercial markets, and we were caught wondering how to survive. Like I said, I had 38 companies. 12 of those I should have let go to foreclosure. A few investors get hurt, but I didn't want anybody to get hurt. I wanted to save everybody. Went to my attorney, went to my accountant, developed a story or a business plan that if I took money from profitable companies, put it in non-profitable companies, I could keep the company afloat for the next several months. I thought, hey, this is great. It's a recession. This will last 17 or 18 months. There'll be a 10 or 12% correction in the market. The markets will bounce back. When the markets bounce back, I could put the money back. Nobody will ever know. In the real estate business, we are in a very highly transparent business, especially when we take someone else's capital. We're held at a much higher standard. So we need to disclose everything. I didn't disclose it to my investors what I was doing. So for non-disclosure issues, I wound up being sentenced on wire fraud and mail fraud charges, and I got sentenced to 10 years in federal prison. So in 2013, I got wiped out, went to federal prison on a 10-year prison sentence. And a lot of people might think that was the end of the story or the end of the road at that point, but that was just really the beginning for me.
Wow. Yeah, that was quite an unexpected term. We hear so much about, hey, the financial crisis hits and I lost a couple $1,000,000, but picked myself up and dusted myself off and made it right again. But one of the first things I want to hit on that I think you alluded to is that even during the financial crisis, commercial real estate wasn't hit as hard as like the single family market. And it sounds like that it also hit commercial on a delay. You talked about it really coming to bear in 2010 versus the 2008, 2009, when single family was just getting hit super hard. But there's also the follow-on implications of the whole banking sector and the implications that had for just doing business in commercial. Is that an accurate assessment?
Yeah, very accurate. Yeah, there's always a delay between residential and commercial. I've heard people say anywhere from 7 to 8 months to 15 months that there's a delay in there where commercial feels the effects later. But I think it depends on the stability of the stock market and the banks. I think today is different than it was in 2001 or 2008. This time in history is a lot different because I think there's more stability because we have such a housing shortage in this country for good, affordable housing and good product for people to live in, that the rental market will stand a little bit stronger than it has in the past.
Yeah, absolutely. I make that argument a lot. So let's go to lessons learned, right? You said you got hit on wire fraud, mail fraud. And again, it comes down to disclosures. And I think some people don't take this stuff seriously enough, especially when they make that jump from maybe fix and flips up to syndication. When you get into syndications, then we're talking about you're dealing with the Securities and Exchange Commissions. And so whenever you're dealing with securities, there is a greater level of sophistication, complication, and detail that needs to go into these things, both legally, administratively. And so I guess what lesson would you want people to learn from the mistake that you made so that they could avoid the same situation?
Yeah, it's a sprint, or it's a marathon, not a sprint. Take your time, grow slow, grow methodically, pay attention to the details. That's the fourth mistake that I made, was that I didn't pay attention to the red flags around me. And then the fifth mistake I always talk about is, hey, I had people around me say, I don't like what I'm seeing over here with this person or this situation. And I would say, I have this under control, don't worry about it. And I didn't have it under control, and I knew it. My intuition said, you better look at this, but I didn't. And so I think people get caught up in the how do I fix it? How do I repair it? What do I do to save it? Rather than, I think at times we have to cut our losses and move forward.
Yeah, absolutely. And I think another piece of it that gets some people is just, especially when they're newer and they want to try to keep costs down. It's, oh, maybe I could do this without a lawyer, or there's certain professionals that you need to bring in, not just to do it right, but to protect yourself and protect your investors. And so I guess that's another one that I would recommend to anyone. Don't overlook getting a PPM done by a lawyer, or just asking for a second opinion on something that you have that gut feeling that you talked about. If something isn't right, there's something to that.
Yeah, for sure. Like I said, I thought the story was over. I thought it was done. I wound up going to prison in 2013. And what I always tell people, Tim, is I say, hey, I never flew private. I didn't have a boat. I didn't have a big house, not a fancy car. I was the neighborhood baseball coach. I was home most nights for dinner. And I got ripped from that to live in a 12 by 12 room with three men I didn't know, nor did I like, wondering what the hell happened in my life. Kind of being in the Army, huh?
Yeah. Not quite as bad, but on the Army side, but yeah.
So I'm walking around every day wondering how am I going to get through today, much less 10 years of this? And 3 weeks in, my wife decided to divorce me and just wrecked me. And so now my losses were not just business and finance, but family and all that emotional stuff that went with it. And so about 6 weeks in, I go into the gym one day, and I always tell people, I say, hey, look, I'm just window shopping. I was just window shopping. I wasn't looking for anything at that point. And I walk into the gym, and this guy walks up to me. And remember, I went from running marathons to being 35 pounds overweight and hating myself. And when I walked in the gym, this guy says to me, he goes, hey, don't let these people beat you. All they want to do is ruin your life. They can take your finances, they can take your business, they can destroy your family, but what they can't take is who you are and what you're made of. They can't take what's inside of you, the knowledge that you have and how you built those companies. And I don't know, it was like somebody flipped a switch. And I think we all have these defining moments in our life. And at that point, I said, what he's saying makes sense. And he said, come to my class, start working out. I started going to his class. I started working out. I started losing weight. I started to feel better. I wound up going to college. I got a bachelor's degree in theology. I wrote 2 books, one called Exit Plan, Your Complete Guide to Multifamily Investing and Why You Need an Exit Plan Before You Buy. I'd love to get your listeners the e-version of that. I can give them a link at the end. And I wrote an ethics course. So I taught real estate investing, property management, and ethics in prison for 6 years. How ironic, federal inmate teaching ethics. I was on an outreach program. I'd go into the community. I told my story like 40 times to local business owners and college students. And I taught them, what mistakes not to make. But I wound up meeting a professor from the University of Minnesota along the way. And he and I co-authored a paper together that we had published in the Business Journal of Ethics. It gets taught today at the collegiate level for forensic accounting and sales and marketing classes. I came home in 2020 when they closed the world down for the pandemic. So I went from my prison into your prison. And then when I came home, I thought, I'm going to go into coaching and training business. And I'm going to teach people how to invest in real estate and multifamily and not make the mistakes I made, which I started out down that path. But then I was underwriting deals along the way too, trying to get familiar with it again. And I found a deal in Florida, went to a couple of my coaching clients. We partnered together on that. And my securities attorney said, hey, I think I can get you approved by the SEC. And she went and got me approval from the SEC to go back, be an issuer of securities, a sponsor of deals, and raise capital again, which I never thought I'd do again. So it's funny how I had all this success, I lost everything, and now in this redemption period of rebuilding. And it's different today, though. It's different than it was years ago.
Yeah, and one, I'd just like to say it's really inspiring because so many people get beaten down by the prison system and with the federal prison system, and can just see that as the end point and not know where to go from there. But luckily, you had that turnaround moment where someone convinced you that you could either let this beat you down or you could retain all that you had, all that you learned, and move on and create something bigger and add value. And I think that's what you've done with your experience. Regardless of how negative it may have been, you've been able to take that and turn it into something positive for other people. So I think that's very selfless of you to do that. Based on what you're seeing now, as you've clearly gotten back into the game and you've been quite successful at it, what are the biggest differences that do stick out to you? Because you said that it's a very different environment from when you were doing it last.
Yeah. Great question. So there's a lot more people in the syndication business today. I believe today in the syndication business, there's a lot more people with less experience. I never thought I'd raise capital again, Tim. And I was doing a meetup. I was probably out of prison 14 months, not even a year and a half. And I was on a lunchtime meetup, and there was probably 150 people on this meetup. And somebody said to me out of clear blue nowhere, hey, are you raising capital again? And I said, no. I said, I don't think I'll ever raise capital again. And he said, let me know if you change your mind, because I wouldn't want to invest with anybody other than you or someone like you, because you know where the pitfalls are. You've already made the mistakes. And I think we're going to see a lot of stress in the market come up here. You're going to see operators that didn't have a lot of experience, that are in bad loans, that are in bad capital stacks. You're going to see some stress on assets in the marketplace that are going to bring great opportunities to the marketplace for other operators, right? This is going to be a re-engineering of wealth in our country. Every time we go into one of these cycles, new wealth is created. It's a repositioning of the money. I'd like to say they're not making any more money, but they do that all the time. And it's just going to be a repositioning of it. So if you are a passive investor, it's a great time to partner with an operator that has experience, that has knowledge, that's been doing this. And there's a number of us out there that are like that. But I think that there's a lot of people in the space today, a lot of inexperienced people in the space today, a lot of people trying to grow fast. I talked to somebody a month or so ago, and he said, yeah, we did 8 deals last year. And it was like 1,200 units. And I thought to myself, why would you do that? It just, the instability in that type of growth doesn't help anybody. And if the market gets worse, which is possible, I don't know that it will. I think we're going to have a soft landing. But if the market was to get worse, that instability is a problem, because you can't pay your bills.
Yeah. And I think you're right that when some people get into this game, I was excited to do just like my first deal as a GP. Like I was over the moon. I did a 59 unit portfolio deal. I wasn't worried about doing 7 more that year.
Yeah.
That wasn't even within the realm of the possible in my mind. But I think people get focused a lot on these vanity metrics, and that's exactly what they are. Dirty little secret. If I say I have a thousand units, okay, that's great. What is my track record? How many exits do I have? What are my average returns on those deals that do have an exit? And do I have the processes and everything in place to effectively run the assets that I have? Because you can get over your skis. Like I think you were saying that when you grow too fast, you don't have the ability, the time to give to those assets that they need to run effectively. And you owe that to your investors.
Yeah.
Because
100%.
you used your investors' money to get those assets. So if you're not going to the meetings and looking at the KPIs, et cetera, then you're not doing your part as the sponsor of that deal.
100%. You hit that all right on the money. And it's really important because the story's in the math, in the initial underwriting, and then it's in the KPIs. And if you're not asset managing properly, that's where the issue lies. And that was one of my mistakes before, was I wasn't paying attention to the details. I wasn't asset managing like I should be. Today's a totally different ballgame for me. I'll give you an example. I love what you said about vanity metrics, right? And, I own 5,000 units, or we bought 12 deals last year, or we bought 1,200 units last year. Great vanity metrics. But how's the performance? I bought 40 units. We closed it at the end of 21. And I can tell you that I haven't had to stop my returns to my investors. I haven't lowered my potential IRR, that it's increased, and that I'm still hitting an 8% annual cash on cash distribution to my investors. And there's an awful lot of operators in the market today that have stopped distributions, that have cut them in half, that have had to change their performance because their original underwriting was overly aggressive. And I'm so conservative today when it comes to the math.
Yeah. And I think you have to be, just because this market is shifting so quickly. We saw what happened with the rates, these loan terms going from 4% to 7% in the matter of less than a year, and the impact that's had on even getting deals to pencil out. Like so many deals that would have been amazing a year ago just don't make any sense at all, given what the kind of lending that you can get nowadays.
And one of the funny things in the market is that interest rates are higher than cap rates in some markets. And you have to be careful of that, right? Because that's where some disparity can come in. So watch how you're penciling deals.
Yep, absolutely. All right. So we got your thoughts on the market. I did want to ask, though, on your experience, you had mentioned that you are a real estate trainer and a personal coach. Having probably seen many people succeed and fail in this business, what do you think is the biggest factor in whether someone succeeds in multifamily?
It's a great question. I really think one of them is relationships. Multifamily is a team sport today. We don't do it on our own. We don't do it by ourselves. Back a decade ago, when I was building that company, it was me and my partner, and we built everything together. We hired people to do things. But I believe today it's more of a team sport. Everybody works remotely. I've got a partner that I live in Chicago. I have a partner that lives in LA, one in Central Illinois, one in Virginia. So we work remotely today. So you don't have to be in an office environment or a corporate environment. And it's a team sport. Everybody on that team has to buy in to the vision and the goal. And if you're a leader in the multifamily space, do you come to your team with that vision and that goal to help them grow? Because it's not just about your success, but it's about the success of the people around you, your partners, and it's about the success of your investors. I look at a deal today like I'm not worried about my money. I'm worried about my investors' money. You said that earlier. I want to make sure that the investors' returns are there, that they are going to succeed as a result of my actions.
Yeah, absolutely. It's that responsibility that we have. Okay, so this has been some awesome and inspiring conversation, but now we do need to move on to the turbo round.
Okay.
So I'm going to ask you 3 questions that I ask every guest, and I just ask for a quick, honest answer. The first question: what is one red flag every investor should look out for?
One red flag everybody should look out for is what's going on around you. Making sure, like you said, paying attention to those KPIs. If you as an operator, as you as an investor, don't see those fundamentals as being positive, with positive growth, there's something going on. Look deeper and find out what's under the surface. Don't just look at the surface. So I think that one thing is you have to pay attention to the details.
Yeah, absolutely. Couldn't agree more. I know there's probably a lot of passive investors out there who get their monthly or quarterly updates and they probably take a glance at it and keep moving, but there is some definite value in going through those numbers so that you can start to see trends that are taking place. All right, second question. What is a myth about this business that you would like to set straight?
That's interesting you asked that, because I just had a conversation with a passive investor the other day, and he said, I don't have hundreds of thousands of dollars to get in this business. I said, do you really think you need hundreds of thousands of dollars? He said, to buy large apartment complexes. I said, don't you see you could partner with us for a fraction of that? And he was like, really? And we had this conversation around that. So I think a myth in the multifamily space is I could never buy one of those big apartment complexes because I don't have hundreds of thousands of dollars. But you know what? There's opportunity out there for everybody to participate in.
Yeah, and I will readily admit that before I got introduced to multifamily syndications, I had no idea that they existed as an opportunity either. And so many people that I talk to are in exactly the same boat. That's why I enjoy telling them, like, hey, you have another option other than the stock market or bonds or whatever, because they don't know.
Absolutely.
All right, so final question. Mike, what does success look like to you?
Yeah, for me in my position, Tim, success for me today has no monetary value. It's about the accomplishment of the comeback. So I had great success. I had lost everything. And today it's just about the ability to freely come back and have an accomplishment of, I'm successful today because I partnered with a couple of people. We got a multifamily syndication done and they're successful. Our investors are successful. That's success for me today. So when I bring the next one to the marketplace, that my investors and my partners all succeed as a result of our joint activities, and that's success for me today.
Absolutely. Mike, hey, I know our audience is going to take away a ton from this discussion, hearing your ups, then downs, and then clawing your way back up to the heights that you are today. Please tell our guests how they can get a hold of you and if there's anything else that you would like to share with them.
Yeah, absolutely. Thanks, Tim. You know what? Just like you and I connected on social media, I'm all over social media. So whether that's LinkedIn, Instagram, Facebook, TikTok, my YouTube channel. If you go to my YouTube channel, you'll see I have tons of free content out there that people can engage in every day. I'm putting new nuggets out there, things that people could listen to and learn and implement in your business and grow from it. I'd also like your listeners to go grab a copy of my book, Exit Plan. They can get an ebook version. Go to mycoreintentions.com/free, and they can download a copy of Exit Plan. And Tim, I love to network. So anybody who wants to network can reach out, email me directly at mike@mycoreintentions.com, and we can have a conversation or start a conversation there. Somebody wants to be on my podcast, I'd love to have them on. Anytime there's a connection, I try to engage with people.
All right, awesome. Again, thank you for coming on and sharing your story, Mike. I appreciate you coming on and look forward to continuing to see you do big things on your journey to multifamily millions.
Thanks, Tim. I appreciate it. Good to be here.